Good afternoon, everyone. Thank you for joining us for the Klaas Financial 2024 Year in Review. I am Eric Schwartz. I'm one of the advisors here in our Madison office. I am joined by Josh Stirling, our Chief Investment Officer, and Kyle Kite, another one of our advisors. He works down in the Illinois office. He's also our Chief Financial Officer. Just a quick update. I know a lot of us have been on a few of these now, but just a quick update and reminder on who we are at Klaas Financial and who it is that we serve. So we have been in business about 49 years. We were founded way back in 1976. We serve just over 1,000 households across 32 states. Okay, so we have two primary offices, one up here in Madison and one just outside of Rockford, Illinois. We have 20 employees across those two offices, and we manage just under $700 million in assets. Josh, we got to get that number up just a little bit more here.
Oh, yeah. Market will be going up very soon.
And like I said, we work with clients in 32 states as of now. That number's climbing up for us as well. Mm-hmm. Like I said, today we're going to be doing what we call our year in review. Obviously, we have these webinars quarterly, but this is a good opportunity for us to say, what happened in 2024 and how did it impact our clients. Yeah. So we're going to get started here. Kyle, can you give us an update on what is going on or what went on in 2024 with the economy?
Yeah, absolutely, Eric, and thanks again for everybody that's joining us. So yeah, some of the kind of big picture economic stuff that we kind of went through in 2024, and this especially kind of showed its head here towards the end of the year, especially defining consumers. So what we mean by that is that the consumer is still pretty strong. People still, we'll see what the holiday spending numbers come out here in the next couple of weeks of how it actually showed up in the last quarter especially. But overall, the economy is holding up pretty well. People are obviously still spending money. Those of you that have booked any travel plans, obviously hotels, flights are still pretty expensive. There's still a lot of people out doing that kind of thing, which is obviously a good thing for the economy. And this is kind of one of the overarching themes that we've heard, especially from the Fed, is they've been talking about this for probably 18 months now. Are we going to pull off this thing called a soft landing? And what they mean by that is that, we went through kind of those unprecedented rate hikes in that 12-month span there where they went from basically 0 to 5% in a very, very short time. So the worry was that if they raise too high too quick, is that going to dip the economy into a recession? And what they mean by a soft landing is that we were able to increase those interest rates, but not completely, destroy the economy or anything like that. And as of right now, it looks like we're kind of threading this needle where, yes, they've raised interest rates and then they've actually done a couple of cuts, which we'll talk about here in a second. But the economy is still holding up fairly well. And actually, just some more recent news last week, the jobs number came back a little hotter than anticipated. So the market didn't really like that. But then we had the inflation number come out earlier this week and it was a little bit softer. So we still have a lot of these mixed signals, and that's what the market is really, really trying to figure out. But as of right now, it looks fairly likely that we might actually pull this thing off, which is obviously kind of a Goldilocks thing that we would all hope for, right? Is that we've got interest rates up to where they, could be whatever our new normal is going to be. But also, like I said, not dip the economy into too bad of a recession or pullback or anything like that.
And Kyle, if I could ask a question, how common are soft landings?
Not very common at all. But they're hard to pull off, as you can tell, because the economy has so many kind of forces that are fighting each other, right? Is that you got to keep interest rates up to keep the money supply a little bit of tightness, but if you get them too low, then you can bring back inflation. And that's honestly what the Fed is especially worried about right now is if we cut too fast or go too low, is that going to bring inflation back, which we lived through back in 2023, and nobody really appreciated that. We hit 9% there for a couple of readings, which is kind of unheard of. So now we haven't hit their 2% target quite yet, but we're certainly getting down closer to it, which is good to see, obviously.
Yeah, the planner in me would just like to point out, while we did say that it's good for consumers to spend to stimulate the economy, we still encourage responsible spending among our clients. But, I think if there's one thing we're good at as Americans, it's spending money. So we'll keep the economy going.
I think one data point that I did see on inflation is that one thing that we shared a lot with is that shelter behind the scenes is a big component of inflation and why it's been so sticky. And we did finally see it drop down a little bit, which is helpful and a little bit promising. But of course, it takes more than just a couple of months of kind of progress. It'll take a longer time to see how that plays out.
Yeah, so I talked about this a little bit on the opening slide there, but just kind of what we're looking at with what the Fed has done. Like I said, in pretty much that 12 to 14 month there from 22 into early 23, we had unprecedented rate hikes. And then we kind of held there through the end of 23 and almost all of 2024. They didn't start cutting rates until the fourth quarter, basically, of 2024 and the second quarter there, or in the third quarter. So yes, we've held them up there over that 5% number for a little while now. But of course, there you see it on the tail end of that curve. We have had a couple of rate cuts here. The most recent one was in December, was the last rate cut that they did. But we put that average Fed funds rate in there since 1954. As you can tell, that's whatever that is, 70 plus years of data there. That even where we are at that 5% number before they started cutting it, the long-term average is actually 4.6%. So because we've gone through this artificially low interest rate environment that we've had for the last 15, 20 years there, where, rates were basically at 0 and 3% mortgages and all that kind of stuff, that is actually extremely uncommon. And now that we're, like I said, starting to cut back down, we're still right in the range of what the long-term average is. So that's kind of why you're seeing what we've seen in the market, which Josh will talk about this in the end of December, is the Fed came out and said they don't see as many rate cuts this year as what the market was anticipating. So that's why we had that hiccup in December there, honestly. And it's, again, because they don't want to cut too low and then raise inflation. So this will be what we kind of have to figure out over the next few months that the market's going to be looking at is what is our new normal interest rate going to be, right? Is the 8% mortgages are probably a little too high, but they're probably not going back down to 4% like we had there for so long either. So it's going to be kind of this teeter-totter effect of trying to figure out what's the right number to keep a healthy economy, but still get housing a little more affordable, obviously.
And before we move on to the next slide, we'll talk about the market and kind of what's happened with the market. But keep in mind, as you're looking at this slide, at the very top there, you have kind of where the Federal Reserve rate line was. It was over 5%, and it was there for over 1 year at that highest rate. It was really a whole lot of anticipation of when is the Fed going to finally come in and lower the rates. And as Kyle talked about, they finally lowered it at the later half of this last year. And just keep that in mind when we look at what happened in the market in 2024. So on this screen right here, we have the all country world index stock market and the performance that it had all throughout 2024. And as you can see, it has generally gone up throughout 2024. And I'll be honest, I don't think I could have ever predicted this because if you all remember, 2023 was an incredible year. 2023 had a return of 20% for this same index. It was an incredible return, especially after the year we had in 2022, where both the stock market and the bond market were down. So coming out of 2023, you had a lot of people thinking that we were going to have a bit more of a muted year. I mean, nobody expected double-digit returns again. And for a hot minute there, we thought we were going to hit 20% by the end of the year again. Back-to-back years hitting 20% is very, very uncommon. But one of the major themes that we kind of had throughout all of 2024 is that we hit all-time highs over and over and over again. And when we hit these all-time highs, sometimes it can really not hit kind of the mainstream media, or you're going to be hearing a lot about it because a lot of concentration is really on some of those small little divots that you see throughout the year, kind of these panics in the market. But what I can really say is from the first moment that we hit our all-time stock market high, which was back in end of January, that was the first time we hit an all-time market high since November of 2021, before interest rates started escalating really quickly. Throughout the rest of the year, we just hit all-time high after all-time high after all-time high. And that has been really, really beneficial. I mean, that is really the core foundation of investing in the stock market, being a part of those new all-time market highs. As a matter of fact, that is a more common thing than you'd think of. I think it was 3 quarters ago, we had a great graph that showed the frequency that you're hitting all-time highs. And this is it. These are the years to be a part of the stock market, because this is where that compounding interest, that growth really happens. These are really great years to be a part of. So let's quickly talk a little bit about some of those divots, because that is certainly maybe not the narrative that we all kind of came to the end of the year with. There was certainly some volatility throughout the year, and there was certainly a whole theme of we have no idea what's about to happen. And there's a lot of things happening all at once. What Kyle talked about with the Federal Reserve when they're going to cut interest rates, I mean, that was a huge driver coming into 2024. When are we going to finally see the Federal Reserve cut interest rates? I mean, that impacts so many things: borrowing power for individuals, borrowing power for corporations, new corporate bonds that are going to be rolling over in the future. How does that impact profitability? There's so much that comes into that. That can really be a huge driver to market expectations and what's going to happen. And so when you layer that in with all these different things that can be happening, especially around things like the wage growth or the employment rates in the market, seeing, okay, is the economy strong? And we even had this odd balancing act where the economy was almost too strong, where people thought that the Fed wasn't actually going to cut rates. And then this also scare where the economy might just absolutely fall through the floor, and all of a sudden you're in a recession. It's this odd balancing act of, what does all this data mean? How is it going to impact the market? And where's everything going to come out in the end? And so, like I said, these 2 little divots here that happened, well, the first one in April really happened from the Department of Labor came out and they made an announcement, if everybody can remember, that employment growth was actually overstated. So they actually had to come in and say, all these jobs that we said were added actually weren't. And they took those off the table. So the market had a bit of a negative reaction, because that was viewed as a severe weakness in the overall economy. But I mean, you can see a month or 2 later, you're hitting those all-time highs again. The economy turned out to still be strong in all these different areas. You continue to have inflation moderating, and all these things started to kind of turn the table on. There are a lot of benefits, and the market can endure, and the economy seemed to be getting closer and closer to that soft landing. And of course, as we got to the second half of the year, you start to finally see that the Fed cuts rates and you get those buoying effects in the markets. But then all of a sudden we get into the August timeframe. It was a bit of a similar story throughout the year. I mean, you got some positives. GDP came in just under 3%, which is helpful in the definition of a recession being negative quarters of GDP. So getting a positive number is really showing that strength in the U.S. economy. Inflation finally hit 3%, just above that 2% number that Kyle referred to. And we still had a lot of unknowns as well. When was that interest rate cut about to happen? As a matter of fact, it was about to happen right around the corner. How was unemployment handling its elevated rate at around that time? It was around 4.3%. Was it about to go higher? International conflicts with Gaza, Ukraine, and of course, what was going to happen in the election? There was a lot of unknowns really piling up there, and that really led to a bit of a market pullback. And very quickly, for a couple of days there, it was down 4 or 5% just in a rapid recession. But it came back very, very quickly. And as we can see, the end of the year, I mean, we hit the highest point in the market. That blue line right there represents the highest point in the market that we hit, was about 21, 22%. That happened in the beginning of December. But you ask anybody what happened in December, all-time highs is not top of the list.
No.
As a matter of fact, one of the most popular things that happens in December is a Santa Claus rally. This happens from so many reasons. There's not really one narrow focus on why it happens. There's a lot of talk about low volume from institutional traders, tax loss harvesting with rebalancing portfolios. There's a lot of optimism typically at the end of the year, and that can drive a little bit of hope leading into the brand new year. But we didn't have that happen this year. As Kyle said, there was some indication that interest rate cuts weren't going to happen as aggressively in 2025 as the market might have hoped. So we saw a bit of a deflated December. Left the year with kind of maybe not necessarily a bad taste in the mouth, but I think it left it on a negative note when in reality we hit some incredible returns. It was, again, at the beginning of this conversation, I mean, this was an incredible year to be in the market. So really, really happy to see the overall performance in the stock market, and the economy is still showing to be strong while cooling.
Yeah, I think what's interesting and just talking to clients and even just people in my life who are outside of the financial industry, because we're just on the other side of this really, really severe interest rate hike in response to elevated inflation. It seems that everyone is just hyper aware of these things that generally are limited to the folks who deal with this on a daily basis. But I mean, it's been this strange experience of 1 month to the next, just the market living and dying by that inflation report, right? And what does it mean for what the Fed's going to do, and what do the jobs numbers look like? And you have people who you wouldn't expect to be watching these things, like texting you in the morning. Did you see the jobs report? And I'm like, yeah, I did, but I didn't think you'd be asking about it. It's just interesting. And then you see this graph though, and you see this, I mean, lots of volatility throughout the year, as you said, ended up on the higher end. But it's just a strange phenomenon to me, this idea that everybody's an expert investor, or just expert on the economy at this point in time. And it seems to, bear out on the graph right here, as you're seeing a lot of reaction in the market to, these reports that we get.
Mhm.
Well, I think our clients too, you get your monthly statements or you check them online once a month, and like when you see it go ahead and stair stepped up, that's nice. But now you feel like that's your new baseline. And that's why it's important to take a step back of, hey, you'll have a bad month here or there, but just go back to where you were at the beginning of the year and just keep reframing the conversation in your own mind that, hey, you know what, we still had a good year overall. Yeah, the end of November looked better than the end of December, but it still was a fantastic year. So
Yeah. In a couple of slides, I'll share that we're going to have a slide that shows about the past 25 years of returns. So we'll get there. We'll look at kind of the big picture in a little bit here.
Yeah.
But so this slide, we're kind of talking about the stock market, but let's go ahead and look at the bond market. So the bond market during 2024, the overall theme on this is that the bond market is still recovering. In 2024, we had a return of about 1.4%. Now, bonds traditionally don't return as much as the stock market, but of course, we'd certainly hope for a little bit more return out of bonds. But a lot of the driving factors behind kind of that muted bond return really comes from what the Federal Reserve is doing and the way that they're positioning what they're going to be doing in the future and kind of the market expectations. We've talked about it a couple of times already, but really around market expectations of, hey, how many times is the Federal Reserve going to cut rates next year? Where do we think long-term rates are going to be over the next 10, 20, 30 years? And those expectations have a direct reflection on the bond returns over any period of time. So in 2024, at the beginning, there was still a market expectation of we'll get back down to lower rates. We'll eventually really cut, and things are going to be back, maybe not the way over the 2010 to 2020 timeframe, but still much lower than they currently are. And over the year, you have this realization of No, the interest rates might be higher over a longer period of time, and that reality started setting in. And so even though the returns are positive, that's why you're seeing a little bit more of a muted return on the overall bond market. But the one really positive thing that we've seen from this is that the yields that you're earning on the bond market, the interest rate, the coupons that you're receiving, are still pretty high, historically speaking, over the last 20, 30 years. Earning a 4.5% yield is still quite strong. And as the bond market moves in the future, we could see better positive returns in the future. So we wanted to cover this mostly to recognize that, yeah, 2024 had a bit more of a muted return for the bond market. We would have preferred for a higher return during this year, especially now that we've kind of started hitting those Federal Reserve rate cuts. But honestly, we're not worried because the bond market is in a really good position from the perspective of interest rates, where they currently are and how they'll be able to handle everything going forward. So
Yeah, one thing I just add here, especially for our retirees who are likely drawing money from their retirement accounts to supplement your other income sources, the yield is really, really important. Now, it's not always the center of what we see, especially when we get our statements, but the yield is the interest that you're receiving in many cases on a monthly basis, right? Your actual interest payments from these bonds that you own within your investment portfolio. So that 4.5% yield is really, really important, especially when we say, okay, it's time for your monthly withdrawal. Where is that coming from? Well, a good chunk of it is the interest payments that you receive off of your bonds.
All right, well, let's go ahead and let's look at a bit of a fun slide here. So we're going to kind of take a look real quick and see how Wall Street analysts predicted 2024 returns. So this chart here comes from Bloomberg. And they went out and they did an evaluation of all the top analysts across Wall Street. They looked at, as of December 2023, what were their predictions of what the S&P 500 was going to return by the end of 2024. As you can imagine, coming off a year when the stock market was producing 20-ish% in returns, there was not a lot of hope to get that kind of performance performed again in 2024. So the graph that we're looking at here, that black dot shows what the original targets were for each analyst. Down at the bottom of the graph, over by where that 6K number is, that little yellow dot shows about where the stock market finished at the end of the year. And so as you can see, all the black dots are very, very far off from where the S&P 500 returned by the end of the year. And that 6K number, that is at the actual price of what the S&P 500 is. So to put this into perspective, the S&P 500 started 2024 at around $4,700. And by the end of 2024, it ended just under $6,000. All of these analysts, or the majority of them, actually made adjustments in between Octoberish, June and Octoberish timeframe. They refreshed their updates, and the vast majority of the updates still didn't even get to where the S&P 500 ended by the end of the year. So I guess we'll pause for a quick second. Why are we looking at this? And the answer is that it is so difficult to predict where the market's going to end up year to year. Even after a stellar year where you think, oh, the likelihood of it returning a performance like it did the previous year is so unlikely. Even those years, it's so difficult to predict on what's actually going to happen. This is really the steadfast reason is why we don't try to time the market, why we really take a step back and say, you know what, it's not about timing the market, it's about the amount of time that you spend in the market. It's one of the most powerful aspects of being an investor is getting invested and staying invested. There's a ton of power in that.
Yeah, we're going to talk more about this in a second here, but you can see I'm kind of giggling over here because this is such a hobby horse for us, just given the way that we view the market. And there are so many, people and marketing dollars out there trying to convince people that, they know best and they can predict what's going to happen in the market. So you should work with them or pay them to tell you what's going to happen. And time and again, we see things like this, right? Now, I'm not to say analysts are always wrong or anything like that, but it's just really hard, everyone, to predict exactly what's going to happen in a given year. And just to put some numbers to what we're seeing here, the average analyst expectation of return for the S&P in 2025, or I'm sorry, 2024 was 2%. The S&P ended up 25% for the year. Okay, and this isn't new. Like 2023 was kind of the same story. The average expectation was about 6% rate of return. The S&P ended up 24%. Now, this isn't to say that the S&P is always going to outperform, right? It could underperform the expectations. It's just a matter that you can really see the difficulty in guessing, and you could say maybe an educated guess, but predicting exactly where the market's going to go in any given short time period. You look over long time periods, the market becomes, you can create some more expectations around it, but short periods of time are just really, really hard to be certain about.
Mm-hmm. One of my favorite things that happened in 2023, on January 31st, 2023, Michael Burry, who is a very well-known investor who actually predicted what was going to happen in 07, 08 with mortgage-backed security market and the Great Recession, and made countless dollars for his clients. He came out and decided that he was going to post sell period on Twitter. And he posted this in January of 2023. And since then, the S&P 500 has been up 47%. Even the best, who do occasionally make incredible predictions on the market and make incredible amounts of money, are still wrong, at least occasionally.
All right, so Josh promised earlier we were going to look at some returns over a little bit longer period of time. So for those who have joined us before, you've seen this slide at various times throughout the last few years. But what we're looking at here is the performance of what we refer to as the 60/40 portfolio since 2000, going up through the end of last year. And the 60/40 portfolio, this is kind of your classic moderate balanced portfolio, right? 60% equity, 40% fixed income. And it's the reason that we reference it here is a fair number of our clients, a good chunk of our clients actually use this portfolio. So it's a way for us to kind of say, what has this done over time as we look back? So you can see we have quite a few events here along the way. We have the dot-com bubble bursting. We have the lost decade between 2000 and the financial crisis, the Great Recession there. We have the pandemic, and then the market drawdown as interest rates spiked. Now, first of all, it was very interesting as we were putting this all together for us to look at this and go, wow, the pandemic was quite a while ago. Mm-hmm. As you look at that, we've had other market events happen since then. But the point of looking at this is, this is buying and holding a 60/40 portfolio along the way, and rebalancing as you need to as you move through time. But this is why we sort of preach what we do in terms of getting invested, allocating appropriately, and then making sure that you are sticking to that strategy. So if you invested $150,000 back in 2000, that $150,000 is worth somewhere in the neighborhood of $575,000 today. Okay, so it's a 283-ish% return, and that works out to a little better than 5.5% per year. Remember, not on a full stock market portfolio, but a moderate balanced portfolio with about 60% in stock. And it seems like we're kind of taking a victory lap here for our view of investing. But, time and again, we just see it's, as you said, Josh, time in the market, not timing the market.
Well, I think one of the big themes that we try and focus on here is that we're not trying to do absolute returns for everybody. We're not trying to hit 20-30% returns every single year. For a lot of our clients as retirees, that's not sustainable. A lot of individuals can't handle, at least financially or emotionally, the volatility that comes along with returns like that. So we try to smooth out the ride as much as possible to try and make a predictable, understandable, and financially viable retirement. Those are some of our big themes that we have.
You can see when we zoom out here, a lot of these things that felt like, catastrophic at the time, and frankly, for a bit they look like blips along the way, right? Because the equity markets are just so powerful over long periods of time.
All right, we got one other fun slide here.
Yes, this is a really cool slide. I want to make sure that I do a good job of explaining what we're looking at here. But this is something that Josh and the members of our portfolio management group did some research on to put together for us. But what we're talking about here is, again, what I was just kind of saying about timing the market, trying to say, I'm going to wait till just the right time to get in. I'm going to sit on the sidelines otherwise because, I think the market's just overvalued. And Kyle, you and I hear this all the time from clients, we're at all-time highs. I probably shouldn't invest more right now, right? Because I should wait till it comes back down. But the funny thing is the all-time high you're referencing at that point is probably not going to be an all-time high, within the next 6 months or so, potentially. That's how it felt in 2024, at least. But what we often hear from clients is, I have a chunk of money I want to invest, but I'm going to wait for a correction. I'm going to wait till the market comes down a little bit. A correction is defined here as a 10% drawdown or drop in value of the market, and clients will often reference this is when I'm going to get invested. So what we're looking at here is we're looking at the S&P 500. We're looking at data between 1988 and 2014, okay? And we're looking at basically if you had invested any time during that stretch, the rolling 10-year returns on the portfolio. Okay, so basically we're looking at, first of all, whether a market correction occurs, and in the S&P over a 10-year time period, about 46% of the time there actually is a correction in that 10-year time frame, which means more than half the time we don't see a 10% correction that allows people to jump into the market based on that information.
Which means if somebody said, I've got 50 grand on the side, I'm going to sit and wait until a correction happens, more than 50% of the time, it just sits there.
Correct, because there's no 10% reduction to get into the market. So then we look at what does the S&P do if you had just said, I'm not waiting for a correction, I'm just going to invest. What has it done over the next 10 years? You can see in that slide, or I'm sorry, the bar on the far left, it returned 116% over that 10-year time frame. Now on the next one over there, we can see, okay, well, what if I did wait for a correction? What if I guessed just right? You picked the right day, and then you invested the money over that 10-year time frame. What are we actually looking at in return? What it boils down to is, yes, if you are able to guess just right and get in just at the timing of the correction, you might get an extra little more than 1% per year in rate of return. But more than half the time you'd end up on the right here and say, I never invested because we didn't run across the right amount of drop in the market to actually invest. Okay, so it's just coming back to our view that it is important to be invested in the market, not to time it just right and get in on just the right day or month or even year.
Yeah, I think one of the key takeaways from this that we use in kind of return opportunity and where you should be invested and whatnot is lost opportunity. And I think a lot of times it's difficult to look at a scenario and say, well, but if a market correction occurs, I'll be better off waiting. But the opportunity of simply not being invested is a really big deal. And so trying to predict when a market correction might happen is one, already incredibly difficult. If people could predict it, they would, and they make a lot of money off it. But then secondarily, just simply not being in the market and trying to wait for an appropriate time to invest is just a losing game from the get-go on average over this time frame that we're looking at. So our viewpoint, when individuals come in and they say, I've got a chunk of cash, when should I invest? It might sound overly simplistic, but that's why we say now. If you have the money and you're okay with investing it, now's the best time to invest it. Like I said, it's kind of a simple answer, and it might come across not really genuine, but it's really coming from a place of academic research of, well, what does it look like if you were to wait? Should you be investing in the market during all times, no matter what? Well, what about the PE ratios on the S&P 500, market concentration, like all these different factors? And the simple answer is just invest now. That's the best time to be a part of it.
Yeah, and this really comes back to, yes, invest now, assuming that you have the time frame, that it would take to actually allow the market to work. Because like I said earlier, over longer periods of time, the market becomes, we'll say, more predictable, right? And that's why it often comes down to, well, as long as you're investing for a while, it's, now is the time to get invested, right? It's when you're looking at those shorter periods of time that it becomes, you need to think about whether or not you really are in a position to be investing those dollars, because you need to have a long enough time frame to do it. But this has just been really interesting, as we look at kind of how people approach investment management and I guess the psychological approach to investing.
Yeah, that's the big thing, Eric. Like you said, it's the psychology, right? That, yeah, if you can time it right, this is what the math tells you to do. But it's a whole nother thing when you're looking at your statements being down 10, 15, 20%, and to think that, A, I'm going to put more money in as it's going down, which is, we all know that's what you should do, but psychologically it's very hard to do. And then also, this is when we talk about strategy changes with clients as well, is actually you don't want to get more aggressive at all-time highs. You want to wait till we have a pullback if you can, and then get more aggressive. But again, it's the same concept that it's hard to do when you're losing money to get more aggressive, but that's precisely what you should be doing. So.
Yeah, I think that's a good point, because the information we're looking at is if somebody's incredibly diligent and is totally willing to invest into a declining market. And the cold hard reality is that is a tough thing to do sometimes. That is really tough to do. All right, well, why don't we go ahead and move on to some Q&A. We've got a couple of questions that came in. But for those who would like to ask additional questions, at the bottom of your screen, you should see a little Q&A button. Go ahead and type in a question and submit it to us, and we'll answer those live here for you. But let's go ahead and answer the questions that we have here. So the first one that we have is, am I invested in AI? And boy, I think that's an incredible theme over the past 2-ish years that, frankly, has been a huge driver in the market. And I'll kind of answer this in two different ways, and then Kyle and Eric, you can jump in as well. But the one thing I'll say is that it's hopefully somewhat apparent that you're not missing out, because the market has been such a heavy driver of that. And then the secondary thing, I don't want to try and predict what's going to happen, but I will say that this is not necessarily like the tech bubble. If you were coming at it from that angle of, well, what's happening? How's this going to play out? So what I mean by when I say you're not missing out really comes from the perspective of AI is really infiltrating so many different businesses from so many different perspectives. And it's really this thing of just a new market tech gaining exposure all across the economy in different business types and at different levels. And so we're seeing of course, brand new small shops that are popping up that might end up in the stock market. And, there is going to be a shakeout of what companies are legit, what companies are just not driving any revenue at all, total loss. Those are currently happening and shaking out. But we have major corporations with huge R&D departments that are pouring money into AI and finding legitimate ways to develop revenue off of this brand new technology. And while it really has been a trendy topic, we are seeing companies being able to drive revenue off it. It's really an incredible force in the market currently, but we don't see necessarily, not to be predictive on it, but a recognition like the tech bubble back in the early 2000s in terms of the types of companies that are popping up or where the money is coming from.
Yeah, such as new companies. It's,
Yeah.
Every long established companies who have historically been had very little to do with new technologies have figured out that if they just say AI in their earnings call, they'll get a little extra bump on their stock price. But no, I think this is something, and I think this is what you're getting at, Josh, is it's this idea that just by way of investing, you are investing in AI because it's really infiltrated much of the market. And I think when, people ask us, am I invested in AI? At least from what I'm hearing from clients, it's a lot of, I want to make sure I'm not missing out on this, this huge theme in the market.
Mm-hmm.
Mm-hmm. Yeah, it's important too to know, we've talked so much about the Magnificent Seven, right? These big tech companies, and they have piles upon piles of cash. So they are heavily invested in this because that AI, missing the boat on AI could be one of the reasons that one of their competitors overtakes them or gets closer, that kind of stuff. So it's definitely a part of all the portfolios, but especially when you're looking at S&P 500 companies, they just have so much cash that they're pouring into these types of things that absolutely you're exposed to it for sure.
I think the biggest fear this year was NVIDIA because it just kept going and just kept going. And I think you hear a lot about companies being valued so high, and then there's so many expectations for meeting the revenue achievements that analysts are looking for. And NVIDIA kept hitting it and hitting it and hitting it. We finally saw a pause there, and we saw a reflection in the stock price because of that. But it's not only that the infiltration of companies developing AI solutions, but it's also the supply chain of, well, what does it take to implement AI? And we saw that directly from NVIDIA and have a huge, huge run up in profitability and revenue just with that supply chain just becoming unleashed. It was really incredible to see throughout this year. Even though the theme that we've been talking about, there was a bit of a pullback at the end of the year on it. It still had incredible returns.
Yeah, not only meeting analyst expectations, but exceeding.
Yeah.
And you get to a point where if you exceed enough, that becomes the expectation. And so we saw a little bit of a reality check here towards the end of the year.
All right. So the next question that we have, what happened with the Social Security regulatory changes? All right, and I'll leave this to the advisors.
Yeah, this was a big change that just came down here right at the end of the year, essentially. They finally signed this bill into law. So what they signed into law was they basically got rid of two primary things in Social Security. One's called a government pension offset and a windfall elimination windfall elimination. Those primarily impact people that worked in what they call covered jobs, meaning that they were government pensions. The one that we see the most common, especially here in Illinois, is the TRS, Teachers Retirement System. People that have been teachers for many, many years, they pay into the TRS pension. They don't pay into Social Security. So what would happen is even if you worked, let's say you were working in your younger years, you had covered employment, meaning jobs that you were paying into Social Security, you put credits in and all that kind of stuff. But then you got into teaching, and let's say you taught for 20 years and paid into TRS, so you weren't paying into Social Security. When it came time to pull your Social Security, you would actually have an offset because you have that TRS pension. They would reduce your Social Security benefit depending on how many years you worked and what your amount was and all this kind of stuff. So there's a lot of factors that go into it. But essentially what this bill did was get rid of that completely. So it's going to, the people that are going to benefit the most from this is going to be teachers and, like I said, pension employees, but also spouses of people that, you know, if a spouse, let's say there was two spouses, one was a teacher, one was a non-covered worker, they had regular Social Security they paid into. Before they passed this new law, if that non-covered worker were to pass away, the surviving spouse that's getting the teacher's pension would still get an offset on their spouse's benefit because they were a teacher and didn't pay into it. So now this is going to get rid of that. So in theory, it could significantly help, like I said, households where one person was a teacher, one person was non-covered, that teacher is actually going to still get a good portion of their spouse's Social Security benefit. So there's a lot that goes into it. Again, it just got passed towards the end of the year, so we'll still see how this all plays out because it actually was effective as of January 1st, 2024. So now we don't even know what the back pay is going to be. So there's still a lot to figure out, but that's kind of the overarching theme of what changed in Social Security recently.
Yeah, and to our, as Kyle mentioned, this is big for many of our Illinois clients. Our Wisconsin clients, feel free to reach out to us, obviously, with questions on this. What I'll say is for most public employees here in Wisconsin, employees both pay into the Wisconsin retirement system and into Social Security. So most public employees in Wisconsin were actually not impacted by the windfall elimination provision or the government pension offset. So this largely does not apply. That's not to say it doesn't apply to anybody. Here in Madison, our firefighters do not pay into Social Security, so they are impacted by this change potentially. But from a retiree perspective, it's pretty exciting.
And the impact overall is a net positive to everybody, right?
Correct.
Mm-hmm. Yep.
Yes. So basically, you know, for the folks who were working primarily as a non-covered employee, as Kyle was saying, essentially they were having reductions to their benefits that they were eligible for from the work they did while they were covered, right? So it was like this reduction in their benefits, which for a lot of people didn't make sense because they're like, I still worked outside of, you know, I still paid into Social Security. It's just that for a lot of years I was not paying into Social Security, so I should still get benefits for the time I did work. And that's sort of the remedy that we're seeing here.
All right, excellent. Well, that is actually all the questions that we have this quarter. A little light, but we'll have more questions, I'm sure, next time around. So thank you, everybody, for joining us. We will look forward to seeing you in about 3 months for the first review of 2025. Bye.
Bye, everyone.